Welcome to Iron Financial. This is the only place that forges stronger portfolios by putting companies through a true stress test. We don't do hype, we do strength. Our mission? It's to find out if a company is a fortress you can actually build on, or if it's just a facade, one that's waiting to collapse. Today, Bath & Body Works, ticker BBWI, is right in the hot seat. Now, everybody knows the name, but in this market, that means absolutely nothing. So is it a fortress, or is it just a house of cards? Let's dig in.
Okay, so let's get right to the core of this thing, the real conflict. The headline looks pretty darn good, a solid earnings beat for the quarter. They stepped up to the plate and they absolutely delivered. But then you look at the market's reaction, and the stock just got hammered.
Right, so what gives? Why the huge disconnect here? It makes zero sense. They report good news and the stock tanks? I mean, that is exactly the kind of thing that drives investors nuts.
It's the classic Wall Street story, isn't it? The past looks great, but the future looks cracked. They cut their guidance for the upcoming year, and that sent a shockwave of fear right through the entire market.
So the real question here is, what's the truth? Is it the strong quarter they just put up on the board, or is it the weak future they're telegraphing to everyone? Which one are we supposed to believe?
All right, let's start with the bull case. Before we start swinging sledgehammers and looking for cracks in the walls, we have to inspect the structure itself. And honestly, from this angle, the company looks pretty solid. Look, in what has been a truly brutal retail environment, Bath & Body Works isn't just surviving. It's actually executing. They're rewarding their shareholders, and they're laying the groundwork for future growth. So let's take a look at the evidence.
Okay, so they beat expectations. Let's see the actual numbers. Was it just a little squeaker of a beat, or did they really, deliver? Oh, they delivered, and by a lot. The street was looking for $1.75 in adjusted earnings per share for that critical fourth quarter. They came in and posted $2.05. That is not a beat, that's a 30-cent demolition of expectations. This tells you one thing: management has a firm grip on the wheel. They controlled their costs, they drove those crucial holiday sales, and they delivered on what they promised. That's just straight-up competence.
And look, don't just take my word for it. The CEO, Daniel Heaf, he said it himself right there on the earnings call: focused execution. This wasn't some lucky break. He's pointing to specific strategic wins. They launched on Amazon ahead of schedule. I mean, that's a huge move to go out and capture a whole new customer base. They're in the middle of rolling out a brand new identity to stay relevant. This is a management team that has a plan, and more importantly, they are hitting their targets. That is what builds confidence, from the C-suite all the way down to the shareholder.
Okay, so they're making money? Fine, I get it. But what are they doing with it? Is it just sitting on the balance sheet collecting dust, or is that cash actually going back to the people who own the company? They are giving it back to the owners. And that right there is a crucial sign of a healthy structure. $400 million in stock buybacks just last year. That reduces the share count and provides an automatic boost to earnings per share for every single remaining shareholder. It is a crystal clear signal from management that they believe their own stock is undervalued. Plus, you've got a consistent 20-cent dividend every single quarter. Look, this isn't some pie-in-the-sky growth stock. It's a mature business putting real cold, hard cash directly into shareholders' pockets. That's the bedrock of value.
And none of this is happening by accident. They have a named strategy, a literal blueprint for this build-out. They call it the consumer-first formula. They're accelerating innovation in their core products, the candles, the soaps, their hero categories. They're modernizing the brand so it doesn't look like some relic from a 90s shopping mall. They're aggressively expanding their distribution with major moves like that Amazon launch we talked about, and they're simplifying their internal operations to boost profits. It's a logical, multi-pronged plan. And that, in a nutshell, is the bull case: a competent team, a smart plan, and a company that rewards shareholders for their patience.
Whoa, hold on a minute. That's a great story. And from the outside, it looks like a sturdy building. I will give you that. But here at Iron Financial, we don't just stand back and admire the paint job. No, we bring in the engineers, and we check the foundation. And let me tell you, when you start tapping on these walls, you start to hear some very, very hollow sounds. The entire bull case you just laid out is about the past. Investing is always about the future, and that is where this entire story starts to completely fall apart. So let's start looking for those cracks. Let's start with the single most important number for any retailer on planet Earth: sales. Are they selling more stuff this year than they did last year? For Bath & Body Works, the answer is a hard no. Just look at this chart. This is their own forecast. They are guiding for a decline in sales this year. Not flat, not slow growth, a decline. They are explicitly telling Wall Street, we expect to sell less product. How can you possibly call a company a fortress when its entire territory is shrinking? This is the first and honestly the biggest red flag. The core business is going in the wrong direction. And if sales are going down, you know what happens to profits. It gets even worse. Remember that great Q4 EPS number you were so excited about? The one over $2? Well, that's history. Ancient history. For the full year of 2025, they delivered an adjusted EPS of $3.21. Now look at their guidance for 2026. They're projecting a range of $2.40 to $2.65. That is a massive haircut. We're talking about a potential drop of nearly 25% in core profitability year over year. This isn't just a sputtering engine. This is the financial equivalent of a flashing red warning light on the dashboard, and the alarm bells are ringing.
And this isn't some one-time mistake. It's a pattern. It's a pattern of broken promises. You go back to June of 2024, the company was on conference calls touting growth and all these new drivers. Then, just a couple of months later in August, boom, they cut guidance. The stock drops almost 7%. Okay, you think maybe it's a fluke. But then, in November, they do it again. They slash guidance. And this time the market is furious. The stock gets absolutely annihilated, dropping almost 25% in a single day. This isn't focused execution. This is a management team that is consistently over-promising and under-delivering. And that's a major credibility problem.
And what happens when you keep surprising the market with bad news and your credibility is completely shot? You get sued. And this isn't just some disgruntled blogger we're talking about. There's a securities fraud class action lawsuit alleging that the company made materially false and misleading statements. The suit claims management knew their strategies weren't working and that they were way too reliant on promotions, but they went out and painted this rosy picture for investors anyway. Look, whether they win or lose this thing, it is a massive blow to their credibility and a huge expensive distraction. The bears argue that these cracks we're finding, they weren't accidents, they were intentionally plastered over.
Okay. The bear case is strong. I'll concede. The guidance is definitely weak, and that lawsuit is a serious issue. No one can deny that. But there's more to the story here. Sometimes, when you're renovating a building, you have to put up some scaffolding. It might look ugly from the outside, it might obscure the view, but it's a necessary support structure while you do the heavy lifting inside. The bears, they see financial engineering. I see smart financial management to get through a tough period. So let's really dig into the numbers that are causing this whole debate.
Now, look at this table. It breaks down their entire guidance. The company is guiding for reported earnings of $3 to $3.25 per share. Now, on the surface, that looks pretty solid, right? It's pretty close to last year's number. But look at how they're getting there. It's an accounting illusion. They have a 43-cent gain from a one-time legal settlement, something to do with interchange fees. Then they've got another 31-cent benefit from resolving some old tax issue. These have absolutely nothing to do with selling candles and lotion. So when you strip out these one-time, non-operational gains, you get right back to that ugly core number we talked about, that 240 to 265 range.
So the question is it skillful management using one-time wins to bridge a tough year?
Or is it just accounting tricks to hide how bad the core business really is?
And that is the billion-dollar question for anyone looking at this stock. Is this just scaffolding, or is it wallpaper? One-time gains are real cash, I get that, but they don't repeat. You can't count on winning a lawsuit or getting a surprise tax break to drive your profits next year and the year after that. The core business, the engine of the company, it has to stand on its own 2 feet. So are these financial moves a sign of a savvy management team that's navigating a difficult transition, or is it a sign of pure desperation, a company just trying to make the numbers look good for one more quarter while the real foundation continues to erode right out from under them? That's what you have to decide.
All right, we have laid it all out on the table. We've seen the bull case, a structure of strong execution and real shareholder returns. And we've stress-tested it and found some deep cracks in the core business and, frankly, in management's credibility. We've examined the wild cards, those one-time items that are holding up the guidance. Now it is time for the Iron Financial stress test verdict. Do you build or do you bail?
Let's summarize the reasons to build. Let's give the bull case its final fair hearing. They smashed their Q4 expectations. That is not an easy thing to do in this environment. They are actively returning capital to shareholders through consistent dividends and aggressive buybacks. Management has a clearly articulated plan, that consumer-first formula, and they are hitting some of their key operational targets, like that Amazon launch. And you simply can't ignore the fact that the stock is up over 19% in the last 3 months. The market is trying to believe in this turnaround story. There are tangible signs of strength here. But the signs of rot are deep, and they are structural. You simply cannot build a long-term investment on a foundation of declining sales. It's impossible. You cannot ignore a potential 25% drop in core profitability. The fact that their headline guidance is being propped up by almost 75 cents of one-time non-operational gains, that's a massive red flag.
It feels like a mask. And then you add the uncertainty and the credibility damage from an active securities fraud lawsuit, and the big picture just looks grim. And yeah, while the last 3 months were good, the last 12 months have been an absolute disaster for shareholders, with the stock down 35%. The long-term trend is pointing in the wrong direction.
So, after putting all the evidence on the scale, the verdict from Iron Financial is clear. While management did an admirable job in the fourth quarter, the forward-looking outlook reveals a structure with just too many stress fractures. The very foundation of the business, its core sales and its core profitability, is eroding. That is a fundamental problem you cannot paper over with one-time games. And the ongoing securities lawsuit, well, that adds a layer of risk and uncertainty that's impossible to quantify. For a new investment today, the risks simply outweigh the potential rewards. The structure is not sound enough to build on.
So, we're going to leave you with this final thought. Management has a plan, right? The consumer-first formula. They believe it's the right mix of mortar and steel to fix the damage.
The question for every single investor is, will it work fast enough? Can they possibly patch these deep cracks in sales and profitability before the entire foundation gives way?
Right now, it is way too risky for us to bet on. But this is definitely a situation we will be watching very closely. Thanks for joining us on Iron Financial. Stay strong.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.